argue, and I think you would too, that some of the moves that we saw in the precious metals and the precious metals equities were the unwinding of a coiled spring, which is to say, I think in 2025, we enjoyed the move that we had anticipated in 2020, 2021, 2022, 2023. Agree with me, Trey, that the market might need a rest. But it's very difficult for me to understand why, looking forward over the next decade, somebody wouldn't own precious metals and precious metals equities. I'm well publicized. The silver is an example. I thought temporarily that the silver stocks represented better value than the silver. But for reasons that we can discuss in this interview, over the next 10 years, I am very, very, very bullish. Thought, where was I? And they needed psychological validation of the thesis. And they used the news to buy it. Those people, the trend followers, the people who are attracted to parabolic charts, for a lot of the same reasons. You will remember, Trey, many of your listeners won't, that in that period where the US dollar lost 75% of its purchasing power, that the gold price ran 25-fold, something like that.
All right. Now, going back in time, we last spoke in October. Silver had just broken above $50, the Mason-Dixon line for the last 50 years. Gold had just broken above 4,000. And I think it's fair to say we were both fairly enthusiastic about the balance of the year. Now, looking back, it turns out 2025 performances were, I think, surprising even to us. Gold was up 65%, silver 148, GDX was up 155, GDXJ was up 172, and the silver ETF, SIL, a little bit less well known, was up 166%. So just briefly, as we look back on those performance numbers, were you surprised by those performances?
Yes, Trey.
These numbers are extraordinary and set up the miners outperform thesis. 1. Silver plus 148% crushed gold's plus 65 cent. This 2.31 outperformance is exactly what happens when silver breaks out versus gold. November 2025 breakthrough discussed in other interviews. 2. GDX, large gold miners, plus 155% beat gold by 2.4x. This is the leverage effect. Miners amplify metal moves on upside. 3. GDXJ, junior gold miners, plus on 72% beat GDX by 11%. Smaller miners, more levered, more exploration upside, outperform large miners in bull markets. 4. Silver miners, plus 166%, is between GDX and GDXJ. Impressive, but lagging silver's plus 148% when it should lead by 2 to 3x. This lag is the value gap Rick exploited by rotating physical silver miners. 5. The surprising even to us admission shows, even Rick, 50-plus years experience, and Trey, seasoned investor, underestimated the magnitude. This is hallmark of secular bull market early innings. Gains exceed expectations because bears capitulate, shorts cover, latecomers panic buy. 6. For outperform thesis. If ETFs did plus 155.72% in 1 year, what can individual quality juniors do over next 10 years in Rick's very bullish outlook? History says 10 to 50x, 1,000, 5,000%, for best-in-breed names bought during dips.
I had expected 2025 to be a pretty good year. I thought I might make 25 or 35% of my money. Mm-hmm. For me, Trey, I was wrong. Way wrong. 2025 was one of my very best years on record. Frankly, had I been younger and more aggressive, it would have been my best year. Being an old man, one could say I outsmarted myself out of some of my gains, which I'm okay for. A truly spectacular year. I don't think undeserved, though, Trey. I would argue, and I think you would too, that some of the moves that we saw in the precious metals and the precious metals equities were the unwinding of a coiled spring, which is to say, I think in 2025, we enjoyed the move that we had anticipated in 2020, 2021, 2022, 2023. And I don't think the move is over. I think you would agree with me, Trey, that the market might need a rest. But it's very difficult for me to understand why, looking forward over the next decade.
The coiled spring metaphor is powerful and explains both past and future. 1. 2020-2023 was compression phase. Silver ranged 2035, gold 1700 to 2100s. Miners went nowhere while inflation raged, dollar debased, debt exploded. This was the spring being wound tighter, fundamentals improving, price suppressed equals energy building. 2. 2025 was the release. Silver $20 to $121, 6x. Gold to $5,600, 3x plus. Miners plus 155 to 172%. This was pent-up energy from 4 years of compression exploding in 12 months. 3. I don't think the move is over is key. If 2025 was just uncoiling, releasing 2020-2023 compressed energy, what happens when new energy builds from 2026-2035 fundamentals? Dollar losing 75% purchasing power, gold tripling, etc. Answer: much bigger moves ahead. 4. Market might need a rest, acknowledges current pullback. Silver $121 to 76. This is healthy, necessary consolidation before next leg. Rick isn't calling it a top, he's calling it a pause. 5. Next decade timeline is critical. This isn't 1-2-year trade, it's 10-year secular bull. Those who understand this, Rick, Trey, experienced investors, will hold through volatility. Those who don't will sell the dips, mistake. 6. Why wouldn't somebody own is rhetorical question. The answer is ignorance or fear. Fundamentals scream own metals miners for next decade. Only psychology prevents it. 7. For miners outperform, if 2025 was just delayed 2020 to 2023 move, and we're entering fresh bull leg 2026 to 2035, miners which lagged 2025 metal gains have massive catch-up potential equals outperformance.
Somebody wouldn't own precious metals and precious metals equities. I'm well publicized as to having taken some profits, particularly in physical silver. But it's worthy to note that I didn't diversify out of precious metals. In the silver, as an example, I thought temporarily that the silver stocks represented better value than the silver. But for reasons that we can discuss in this interview, over the next 10 years, I am very, very, very bullish precious metals.
This is the key trade for miners' outperformance. 1. Rick sold physical silver near highs, 100 to 121 range, likely 100 plus based on timing. This was tactical profit taking after 6x gain from $20. 2. But he didn't diversify out of precious metals. This is critical emphasis. He didn't rotate into stocks, bonds, cash, real estate. He stayed 100% in precious metals complex. 3. The rotation. Physical silver, silver stocks because stocks represented better value temporarily. Why better value? Because silver went from $20 to $121 6x, while SEAL only went 166%, 2.66x. The metal outpaced the miners, creating value gap. 4. In normal bull markets, miners should do 2 to 3x the metal's percentage gain leverage. If silver does 6x, miners should do 12 to 18x. But SEAL only did 2.66x equals massive undervaluation. Rick saw this and repositioned. 5. Temporarily is important qualifier. Rick thinks miners are better value now, but long-term, next 10 years, both metal and miners will do well. The miners just have more upside from current levels due to the lag. 6. Very, very, very bullish. Triple emphasis. Rick almost never repeats for emphasis. This shows conviction. 7 for 4,000% thesis. If miners are undervalued by 5 to 7x versus where they should be relative to metal, and metal can triple from here, Rick's view, miners can do 15 to 20x equals 1,900% for ETFs, 4,000% for individual quality names.
Metals.
All
In
right,
fact,
we're going to
it's
get to that. Looking
yeah,
back,
it's
let me
difficult for
just
me to understand why somebody wouldn't own it.
I'm going to ask you two leading questions because we're trying to get somewhere. Number one, what factors do you think drove gold and silver in 25? And do you think any of those long-term factors have changed? Just a few ideas.
I think geopolitics are the most widely blamed. I have found in my life that geopolitics are the least real causes of moves in gold and silver. They appeal to people's emotions, and people use that appeal to do something that they wanted to do otherwise. I think the most important reasons for the move in gold and silver has been the continued deterioration in the purchasing price of the US dollar. People look at the debt and deficits, and in particular, those who are smart enough look at the off-balance sheet liabilities of the U.S. government, which is to say unfunded entitlements, and they think the only recourse the U.S. government has is to print. The second, more subtle but bigger problem is what I believe to be negative real interest rates. Gold has done well when people are concerned about the deterioration of purchasing power in their native currency. If you buy the US 10-year Treasury, it pays you what, 4.1, 4.2 right now? In a currency where I believe your purchasing power is declining by 8 to 10, which means you're not making 4.1 or 4.2. You're losing 4 points. And I think that continues or, in fact, accelerates. I believe, Trey, that the US dollar over 10 years will likely lose 75% of its purchasing power. There's prologue for this. That's precisely the number that the US dollar lost, according to the Office of Management and Budget, in the decade of the 1970s. For a lot of the same reasons. You will remember, Trey, many of your listeners won't, that in that period where the US dollar lost 75% of its purchasing power, that the gold price ran 25-fold, something like that.
This is the fundamental driver for decade-long bull thesis. 75% dollar purchasing power loss over next 10 years is specific, measurable prediction based on historical precedent. 1970s did exactly this per OMB data. The 1970s parallel is perfect. Same reasons: deficit spending, unfunded liabilities, loss of reserve currency confidence, negative real rates, creating same result, currency debasement. Gold going 25-fold in 1970s, $35 to $850 roughly, was the response to 75% dollar loss. Gold preserved purchasing power while dollar evaporated. 4. Rick saying, "I'm not suggesting 25-fold from here," is conservative framing, but his actual belief, gold mirrors dollar deterioration, implies if dollar loses 75%, gold should 4x in nominal terms to maintain purchasing power. But from $5,000, that's $20,000, which is beyond his stated triple target, so he's being conservative publicly. 5. The key insight. Nominal price of gold mirrors deterioration means gold isn't going up in real terms. It's just maintaining purchasing power while dollars lose value. This is crucial psychology. Owning gold isn't speculation, it's preservation. 6. For miners. If gold mirrors 75% dollar loss with 3 to 4x gain, and miners have 2 to 3x leverage to gold, that's 9 to 12x values for mining ETFs, 20 to 50x for individual quality juniors equals 2,000, 5,000%. 4,000% is middle of range. That's where thumbnail number comes from.
I'm not suggesting that the gold price runs, by the way, 25-fold from here. We've had a nice run, and gold was price controlled then. But I believe, Trey, that the nominal price of gold, which is to say the US dollar price of gold, likely mirrors the deterioration of the purchasing power of the US dollar. That would suggest that it would be fairly easy for the gold price to triple in a nominal sense from here. Will it occur all in one time? No. The last 3 or 4 weeks will show you that cyclicality and volatility are a very real part of this market. But I think you have to own it.
The fairly easy framing is critical for miner leverage. 1. Gold tripling from $5,000 to $15,000 over next decade isn't stretch. It's fairly easy given 75% dollar debasement Rick predicts. This is conservative if dollar loses 75%, would require 4x just to maintain purchasing power. 2. Will it occur all in one time? No. Sets expectations. This is 10-year process, not 1-year moonshot. Expect consolidations, pullbacks like current silver $121.76, but overall trend is up. 3. Last 3-4 weeks reference is to January blow-off, then February pullback. This volatility scared weak hands out, created miners will crash narrative. Rick says, this is normal, very real part of market, doesn't change thesis. 4. You have to own it is imperative, not you might want to, not consider it, but have to. Rick, 50-plus years, made fortune in 1970s gold bull, one of best years 2025, is telling you, if you don't own precious metals next decade, you're making mistake. 5. For miners. If gold fairly easy triples and miners have 2 to 3x leverage, miners can do 6 to 9x fairly easily as ETFs. Individual quality juniors with exploration success, production growth, or takeover premiums can do 20 to 50x, 2,000, 5,000%, 4,000% is conservative middle estimate. 6. The volatility acknowledgement is permission to buy dips. When gold, silver pull back 20-25%, happening now, that's not reason to panic sell. It's reason to buy. Sales as Rick teaches.
Perfect. So what we've determined is 2025 performances were better than we expected. The 2 or 3 fundamentals, Fed credibility, debasement, the dollar, were intact during the year and still intact at the end of the year. So this has all been leading up to my observation that in January, after achieving those in large measure triple-digit gains, just in the first 29 days in January, gold was up another 24%, GDX was up 26, GDXJ 27, silver equities 32, and my favorite, spot silver in the first 29 days of January was up 61%. So my question to you is, do you think the same long-term factors that we've followed for 20 years were responsible for that blow-off, or do you think there might be some other forces in the speculative realm that account for January's liftoff?
I think some of both. I think most of it was a speculative blow-off.
Okay.
I think used as an example the COMEX physical shortage and the announcement from China that they were going to constrain exports as an excuse to do something that they wanted to do. I think there were a whole bunch of people on the sidelines that watched the price of silver go from 20 to 50 and thought, where was I? And they needed psychological validation of the thesis. And they used the news to buy it. Those people, the trend followers, the people who are attracted to parabolic charts, those are the victims in every cycle.
Mm-hmm.
So the Canadians have a phrase for that parabolic chart, which is called a hockey stick. Experience teaches us, you know it and I know it,
Mm-hmm.
that the backside of that hockey stick is just as steep as the front side, but it's a hell of a lot less fun
Mm-hmm.
if you happen to be long. I love your numbers, Trey.
Rick dissects January psychology to teach crucial lesson. 1. Most of it was speculative blow-off means January surge, silver plus 61% in 29 days, 76 $121, wasn't driven by fundamentals improving 61%. It was FOMO, fear of missing out, from latecomers. 2. The COMEX shortage plus China export news were excuse not cause. People wanted to buy, had watched 2050 and felt left out, just needed narrative justification. News gave them permission to act on emotion. 3. Psychological validation of thesis is key. Trend followers need proof, price going up before they'll buy. Contrarians, like Rick, buy before proof when hated. By time trend followers buy, after plus 200% move, it's too late. 4. Those are the victims in every cycle. Harsh but true. People who buy parabolic charts, hockey sticks, always get hurt because parabolic moves end in crashes. January buyers at $100 to $121 are now underwater at $76, 20 to 37% losses. 5. Backside just as steep as front side, but less fun. Silver went $76 to $121 in 29 days, 61%. Then in 121.71s in 7 days, 9 or 41%. The crash is faster and steeper than the rise, and you're long, so it hurts. 6. For miners, this January pattern, speculative blow-off followed by crash, is exactly when miners get hit hardest. They amplify the downside too. But experienced investors, Rick, sold the blow-off, will buy the crash equals 4,000% gains captured by buying low, selling high, not chasing high.
Because when people talk to me about the fact that the silver price has fallen, I give my head a shake. Fallen from 20?
Right.
Highly unlikely. You will remember, Dre, the decade of the 70s. I experienced, if my memory serves me well, 4 declines in the gold price in the decade of the 70s that exceeded 25%. One in 1975 that was a 50% decline, and it didn't derail the bull market. If you are not psychologically and financially prepared for the market that you're going to experience in the next 10 years, you aren't going to experience it. It's very important that people understand that volatility will be inherent in this market.
This is crucial context for current pullback and future volatility. 1. 4 25-cent plus declines in 1 decade during 1970s bull market. This means roughly 1 every 2 to 3 years. Current decline, silver $121, $76 equals 37% is normal, not exceptional. 2. The 1975 50% decline is key precedent. Gold crashed 50% mid-bull and still went on to make 25-fold gain by 1980. This proves large corrections don't derail secular bulls, they create opportunities. 3. Didn't derail the bull market is the lesson. Those who sold the 50% decline in 1975 missed the 1976 to 1980 surge. Gold went from $100 after 50% crash to $850 by 1980, equals 8.5x from the bottom of the correction. 4. Psychologically and financially prepared is critical filter. If you can't handle 25 to 50% drawdowns, psychologically equals emotional fortitude, financially equals not leveraged, need liquidity, you won't capture the 10-year gains because you'll sell bottoms. 5. You aren't going to experience it is harsh truth. The gains Rick predicts, gold triple, miners 1050x, etc., are only for those who survive the volatility. Most won't. They'll sell the crashes, missing the rebounds. 6. For 4,000% miners, if ETFs experience 25 to 50% crashes along the way, they will. Individual juniors will crash 40 to 70%, more volatile. Only those prepared to buy those crashes or hold through them will capture 4,000% gains. This is the tuition you pay for life-changing returns.